Every decade in markets feels unique. Different technologies, different politics, different risks, different stories. And while we are living through it, those differences feel profound. They feel decisive, they feel like evidence that the old rules no longer apply. But when you step back, markets follow a remarkably familiar pattern. That pattern is what I want to talk about today. Not predictions, not what to buy next, not which market will lead tomorrow, but a simple idea that investors repeatedly forget, in my view. Every decade has a dominant investment theme, and every decade investors convince themselves that this time is different. Markets really reward the same leadership forever. Each decade produces a narrative that feels inevitable while it is working and obvious only in hindsight. While returns are strong, questioning the theme feels unnecessary. While capital flows in, concentration feels justified. What makes it so powerful is that usually these narratives are grounded in reality. They are not invented, they are not irrational, they often start with something genuinely transformative. History gives us plenty of examples. In the 1950s, European equities led global markets as post-war construction drove growth and productivity. Industrial rebuilding, infrastructure investment, and demographic recovery made Europe feel like the future. In the 1960s, leadership shifted to the United States and a concentrated group of growth stocks known as the Nifty 50. These companies were viewed as so high quality, so dominant, and so reliable that valuations were considered almost irrelevant. You were supposed to buy them and never sell. In the 1970s, inflation surged, currencies weakened, and leadership moved to commodities and emerging markets. Real assets became the anchor as purchasing power eroded and trust in paper assets declined. In the 1980s, Japan dominated. Its equity market was viewed as unstoppable. Corporate efficiency, export strength, and financial innovation convinced investors that Japan had rewritten the rules of capitalism itself. In the 1990s, American technology took over. The internet changed how the world worked. Productivity surged, globalization accelerated, valuations stretched, but the narrative was compelling and often correct in principle. In the late 2000s, leadership rotated again. Commodities and emerging markets returned as China industrialized, and global trade reshaped supply chains at an unprecedented scale. And in 2010s, extending into early 2020s, US megacap technology became dominant. Scale, network effects, and digital platforms created extraordinary profitability and market power. Different decades, different assets, same pattern. What matters is not which assets led. What matters is how investors behaved. As leadership became established, outperformance created confidence, confidence created concentration, and concentration created fragility. By the time a theme became widely accepted, most of the easy gains had already been made. Capital flowed in not because risk had disappeared, but because success felt familiar and therefore safe. This is one of the most important ideas in investing, in my view. Markets don't usually turn because businesses suddenly become bad. They turn because expectations become too good. When expectations rise faster than reality can deliver, future returns quietly decline, even if the underlying businesses remain strong. Another behavioral pattern appears alongside this. When leadership feels secure, diversification begins to look unnecessary. Exposure feels safe, risk feels controlled. Investors convince themselves that concentration is not really concentration because the companies involved are exceptional. That was true of Japanese equities in late 1980s, of technology stocks in the late 1990s, and of commodities in the mid 2000s. In each case, investors mistook a powerful structural trend for a permanent one. The lesson is not that those assets were poor investments. Many delivered extraordinary long-term value. This brings us to the most dangerous phrase in investing. This time is different. It is rarely said loudly, often said thoughtfully, and usually backed by good arguments. Innovation doesn't stop. Great companies don't disappear. Structural change is real. But markets don't reward certainty indefinitely. Leadership rarely ends with a single shock. More often it fades. Returns compress, valuations stop expanding, alternatives quietly become more attractive, and that process feels boring rather than dramatic, which is why so many investors miss it. There is another subtle point worth understanding. The next decade's leadership rarely comes from where capital is already most crowded. It often emerges from areas that feel uncomfortable, unfashionable, or ignored. Areas where expectations are low rather than high. Areas where narratives are weak rather than convincing. In the early 2000s, emerging markets were dismissed. In the early 2010s, US technology was underestimated. And in the late 2010s, commodities were ignored. And so on. Markets don't ring a bell when leadership rotates. They whisper first. Most investors miss those whispers because they are still defending the last decade's winner. Not because those winners have suddenly failed, but because familiarity is powerful and change is uncomfortable. So, what's the real takeaway from all of this? The lesson is not to guess the next theme. That temptation never ends well. The lesson is to recognize the risks of believing today's leadership is permanent. Understanding how leadership emerged is far more useful than predicting where it goes next. And remembering that every decade feels different while it is happening is one of the most valuable disciplines an investor can develop. History doesn't repeat itself exactly, but it rhymes loudly enough that ignoring it is a choice, and usually an expensive one. If this video helped you better understand how markets evolve over time, you're very welcome to subscribe. And I'll see you in the next video. All the best.